If you're watching this right now, you need to understand something immediately. The silver price you see on your screen is not the real silver price anymore, because while New York says silver is cheap, Shanghai is quietly paying more. And that gap, that difference between paper silver and physical silver, is getting harder to ignore every single week. This is not just a price difference, this is a warning sign. And once you see it, you won't be able to unsee it. Right now, most investors think silver has one global price, one number, one chart. But the truth is, silver is being priced in two completely different worlds. In New York, silver trades mostly as paper, contracts, futures, promises, IOUs. In Shanghai, silver trades as metal, bars, kilograms, something you actually have to deliver. And when you compare these two markets side by side, something strange starts to appear. Before we go deeper, if you want real conversations about silver, physical demand, global stress points, and what the charts don't show you, make sure you like this video and subscribe to Silver Shockwave. This channel is about connecting the dots before the crowd does. Now let's break this down in a simple way. New York sets the global silver price through futures trading. COMEX contracts dominate the headlines. Millions of ounces trade every day on paper, even though only a tiny fraction ever gets delivered. This system works only as long as people believe those paper contracts can be turned into real metal whenever they want. Shanghai works differently. The Shanghai Futures Exchange and the Shanghai Gold Exchange focus heavily on physical settlement. If you buy silver there, someone eventually has to deliver it. You can't just roll contracts forever. Metal has to move. And this is where the gap starts to form. When demand for physical silver increases, Shanghai prices respond faster. Premiums rise. Local prices move above New York. This isn't speculation. This is supply and demand in real time. Factories, solar manufacturers, electronics producers, and investors are competing for the same metal. New York, on the other hand, can suppress price signals with paper volume. If demand spikes, more contracts appear. More supply is created out of thin air. Price stays calm, at least on the surface. But here's the key question you need to ask yourself. If silver is truly abundant and cheap, why does Shanghai keep paying more? This gap is not random. It shows stress. China is the world's largest industrial silver consumer. Solar panels, electric vehicles, electronics, medical equipment, all of it needs silver. And unlike Western markets, China thinks long-term. They secure supply early. They don't wait for shortages to hit the headlines. So when Chinese buyers step in aggressively, Shanghai prices reflect that pressure immediately. Now zoom out for a moment. Global mine supply isn't growing fast. New silver discoveries are rare. Many silver mines are actually byproducts of copper, lead, and zinc mining. That means silver supply depends on base metal demand, not silver demand itself. This creates a structural problem. At the same time, investment demand is quietly returning. People don't trust debt. They don't trust currencies. They don't trust promises. They trust things they can hold. So you have rising industrial demand, tight supply, and renewed investor interest. In a physical market, that means higher prices. But in a paper market, it means something else. It means leverage increases. It means more contracts per ounce. It means the system stretches. The Shanghai versus New York gap is like a pressure gauge. When it widens, it tells you physical demand is pulling ahead of paper pricing. And this isn't the first time we've seen this. Historically, when physical premiums rise in Asia, while Western prices stay flat, it usually ends one of two ways. Either paper prices eventually catch up, or physical metal becomes harder to source at any price. Now think about what happens if a large buyer decides they don't want paper anymore. What happens if they ask for delivery? What happens if multiple buyers do that at the same time? This is where the story gets uncomfortable. COMEX inventories have already shown stress in past cycles. Registered silver rises and falls, but the ratio of paper claims to physical ounces remains massive. As long as most traders roll contracts instead of demanding metal, the system survives. Shanghai doesn't have that luxury. Metal has to be there. That's why this price gap matters more than headlines, more than daily charts, more than analyst predictions. It's a signal from the physical world. And here's another layer most people miss. Currency plays a role too. When the dollar strengthens or weakens, New York prices react instantly. Shanghai reacts differently. Local demand, currency controls, and strategic buying soften that impact. This means the gap isn't just about silver, it's about trust in financial systems. When Shanghai prices silver higher, it's a vote of confidence in metal over paper. And votes are being cast quietly. No panic, no noise, just steady buying. This is why you don't hear mainstream media talking about it. A physical premium doesn't fit the narrative. It doesn't show up cleanly on a trading screen. But it shows up in delivery queues, refinery output, and inventory movement. If you're still watching, you're already ahead of most people. And that's exactly why Silver Shockwave exists. Not to hype, not to panic, but to translate signals the market doesn't want you focusing on. Now ask yourself something, honestly. If silver were truly overvalued, Would physical buyers keep paying more for it? Or would they walk away? They're not walking away, they're locking in supply. And that tells you something important about the future. I'm not saying silver explodes tomorrow. I'm saying the foundation is shifting. Quietly, slowly, and those shifts always show up in physical markets first. Paper markets react last. That's how it has always worked. Before we wrap this up, I want to hear from you. Do you think the Shanghai premium is a temporary imbalance, or do you think it's signaling something much bigger under the surface? Drop your thoughts in the comments. I read them, and they help shape future videos. If this breakdown helped you see silver differently, share this video with someone who still thinks price equals value. And make sure you're subscribed to Silver Shockwave, because this gap between physical and paper silver is not going away. It's just getting harder to ignore, and when it finally closes, it won't be quiet.